Hello, I'm Brent Joyce, Chief Investment Strategist at BMO Private Wealth. It's Thursday, July the 31st. Welcome to our Global Markets Commentary. July saw solid equity market results across the globe, while bond yields generally rose, delivering a mild negative for high-quality bond allocations. Clarity across several fronts important to investors best describes what transpired in July. While not crystal clear, July brought increased understanding of the trajectory of U.S. trade policy, and the result is looking better than what could have been. The passing of the One Big Beautiful Bill brought certainty to near-term U.S. fiscal policy, and it leans mildly stimulative, especially for corporations. Fiscal boosts across other major global economies continue to take shape. With these largely spending-focused, this is another plus for a broad swath of global corporations. Inflation data revealed some clues on the impact of tariffs. For now, the impact looks digestible. Corollary to inflation, consumer spending remains resilient, and corporate earnings growth and margins also delivered positive surprises, shedding light on how businesses and households are navigating the changing landscape. It also became very clear that global central banks, while on pause for now, waiting to see if the early constructive signs and trade deals hold, are biased toward easing monetary policy eventually. There is more clarity now that global trade is being rewired, not short-circuited. The U.S. is in active conversations or has deals in hand with many of its largest trading partners. The timeline with China has been pushed out again, while talks with Canada drag on. However, for Canada, the current environment sees USMCA free trade remaining intact, leaving Canada with an average tariff rate lower than the rest of the world. The goalposts for most of the deals are taking shape and suggest the average U.S. tariff rate will land between 10 and 15%, with China higher and Canada lower. This level can be shouldered by some combination, and now it's going to vary by product, but some combination of corporate margin compression among producers and suppliers, modest price pass-through to consumers, currency swings, and product substitution or altered consumer choices. Equity markets care about things that impact earnings, economic growth, and interest rates. The expectation of this milder tariff regime and the shared absorption across multiple layers of the economy means no single piece is overly burdened to an extent that requires a material repricing of stocks or bond yields. In a nutshell, yes, it's a shock, but it looks like the world can handle it, and there are many other positives, especially for corporations, for investors to get excited about. Given the disruption this year, we will not be surprised if investors pay less attention to the rest of 2025's earnings and economic data than normal. There is enough noise to support both bullish and bearish cases. However, global earnings growth estimates for 2026 range from 11% for the Canadian S&P TSX to almost 14% for the S&P 500, with international and emerging markets in between. If we are correct, and enough evidence continues to point to a solid 2026, investors may eagerly price those outcomes earlier than usual in the calendar year. We suspect a hiccup or two might come along. However, with loosening credit conditions, central bank cuts bringing cheaper money, and large cash holdings on household and business balance sheets, money market funds are swelling. There is a lot of dry powder available to be deployed into equity markets, making any setbacks likely short-lived. That's how we saw the month of July. Thank you for joining us. We look forward to tuning in next month.